When capital chose patience over profit, it wasn't fear that changed the market. It was restraint, a quiet decision made across boardrooms and trading desks to stop chasing what was still working. In that moment, profit stopped being the priority. Preservation did. To understand why this shift mattered, we need to revisit a period when returns still looked attractive. Markets were climbing. Opportunities were everywhere. On the surface, there was no reason to slow down. But beneath that optimism, something had begun to feel misaligned. Risk no longer matched reward the way it once had. Capital doesn't move emotionally. It moves asymmetrically. When upside becomes crowded and downside grows expensive, the smartest response isn't to exit dramatically. It's to wait. And that is exactly what happened. The first reveal begins with positioning that appeared unchanged. Large investors didn't sell aggressively. Portfolios stayed invested. Exposure remained visible. Yet the intent behind those positions had shifted. Time horizons shortened. Flexibility increased. Capital stayed present, but ready. The second reveal emerged in behavior rather than price. New opportunities were evaluated more slowly. Commitments were delayed. Trades that once felt automatic now required justification. It wasn't pessimism. It was discipline. Capital was no longer willing to be first. The third reveal came through what didn't happen. Pullbacks that once attracted immediate buying now stalled. Support still existed, but it arrived selectively. Confidence was no longer assumed. It had to be earned moment by moment. That was the turning point. Capital didn't flee the market. It stepped back inside it. And when enough capital chooses patience over profit, the market begins to change, even if prices haven't caught up yet. What followed would prove that restraint can be just as powerful as panic, sometimes more so. As patience spread, the market's character shifted in ways most people missed. Prices still moved upward, but with less energy. Rallies extended, yet they felt thinner, supported more by inertia than enthusiasm. Each advance required more effort, more confirmation, more reassurance that someone else would still be there. The conflict emerged when this restraint began feeding on itself. When capital waits, it changes what others are willing to do. Momentum traders noticed that follow-through weakened. Short-term strategies lost reliability. Moves that once continued smoothly now stalled without explanation. No rule had changed. Behavior had. Institutional desks adjusted quietly. Risk limits weren't breached, but internal conversations changed tone. Discussions shifted from opportunity to exposure, from how much upside remained to how quickly conditions could reverse. The market still offered profits, but the margin for error felt smaller than the reward suggested. Liquidity reflected the same tension. It didn't vanish, but it became conditional. Buyers wanted proof before committing size. Sellers tested levels cautiously, unsure how much demand truly existed. Depth appeared briefly, then pulled back. The system still functioned, but it required negotiation instead of assumption. Derivatives markets captured the shift more clearly than spot prices. Protection grew slightly more expensive even as volatility stayed low. Skew adjusted not for collapse, but for surprise. Traders weren't betting on disaster. They were hedging the possibility that patience itself could become contagious. The buildup continued as capital allocation subtly changed. Funds favored flexibility over yield, optionality over optimization. Returns mattered, but timing mattered more. The ability to move quickly became more valuable than squeezing out incremental gains. And that preference reshaped the entire market's balance. What made this moment so difficult to detect was how reasonable it looked. There was no fear, no urgency, no visible stress. Just discipline. And discipline, when shared by the largest pools of capital, alters the environment for everyone else. Retail participation stayed strong. Headlines stayed optimistic. Models continued projecting stability. But the investors who shaped liquidity had already made their choice. They were still present, but no longer committed to continuation. The market hadn't turned yet, but it had lost something essential: the willingness to assume tomorrow would look like today. And once that assumption fades, every opportunity carries an invisible question. Is it worth acting now, or is it better to wait? That question, asked quietly by enough capital, begins reshaping outcomes long before price ever responds. That question began answering itself the first time the market was truly tested, not by a shock, but by uncertainty, a data point that missed slightly, a policy comment that lacked clarity, something small enough to ignore until the response revealed everything. Prices dipped, then hesitated. In the past, this was where patience would have ended. Buyers would step in decisively, confident that hesitation elsewhere created opportunity. This time, patience held. Capital waited, not out of fear, but out of calculation. Why rush when uncertainty might offer better terms later? The conflict intensified as that restraint spread. When buyers delayed, sellers pressed a little further. When sellers pressed, buyers delayed again. Each action was rational on its own. Together, they changed the market's balance. Liquidity thinned not because it disappeared, but because it refused to commit. Execution quality deteriorated quietly. Orders fragmented. Slippage widened in places that once felt dependable. Algorithms adjusted conservatively, reducing aggressiveness when signals conflicted. The system began protecting itself from ambiguity rather than expressing conviction. The buildup accelerated as correlations tightened. Assets that usually absorb pressure independently began moving together. Diversification weakened, not dramatically, but persistently. Strategies built to exploit smooth transitions struggled in an environment defined by waiting. Institutional risk teams saw the pattern clearly. Exposure wasn't excessive. Leverage wasn't extreme. But sensitivity had increased. Small moves now carried outsized impact because fewer participants were willing to counter them. Patience, once a stabilizing force, had become amplifying. The market felt heavier. Each move required more volume to achieve the same result. Recoveries took longer. Confidence no longer snapped back. It had to be rebuilt each time, and rebuilding takes time markets rarely have under pressure. Veteran participants recognize the danger. When capital waits collectively, markets lose their ability to self-correct quickly. Balance still exists, but it's delayed, and delay in markets is often enough to change outcomes. The question was no longer whether patience was justified. It was whether the market could function smoothly when so much capital preferred not to act. That tension sat beneath every trade, every pause, every unfinished move. The stage was set for a moment when waiting would stop being an option, when patience, carried too far, would finally demand a price. And when that price arrived, it wouldn't be paid by those who waited. It would be paid by those who assumed waiting would end before it mattered. The price arrived quietly, just as patience had. A larger move unfolded, not explosive, not panicked, but decisive enough to force action. Levels that once invited confident buying were tested and passed through with little resistance. Not because fear took over, but because waiting had reached its limit. That was the climax. Capital that had chosen patience over profit finally revealed the consequence of that choice. When enough investors wait at the same time, the market loses its cushion. Moves accelerate not from urgency, but from absence. The support everyone expected was real, but it was deferred, and deferred support arrives too late. As prices adjusted, narratives rushed in. Analysts spoke of catalysts. Commentators debated causes. But those explanations missed a deeper truth. Nothing new had happened in that moment. The outcome had been forming for weeks. The market was simply catching up to a decision already made. The resolution unfolded in behavior, not headlines. Capital re-entered selectively, not chasing old levels, but establishing new ones. Positions were rebuilt with wider margins for error. Flexibility replaced confidence. The market stabilized, but on altered terms. What lingered most was a lesson. Markets don't just respond to fear. They respond to restraint. When risk-reward tilts quietly, the smartest capital doesn't flee. It waits. And when waiting becomes widespread, it reshapes the environment for everyone else. Patience in isolation is strength. Patience in aggregate is power. But power always has consequences. Because when enough capital decides not to act, the market eventually acts without them. Sometimes the smallest shift in perspective becomes the beginning of a new future. When